As in 8:30, we're going to be talking about some journal entries, okay, related to equities. And these are probably more important journal entries of how they relate to this chapter and how they explain this chapter, even more so than some of the other journal entries we've covered in some of the other chapters about the balance sheet. Okay. In the chapters, I want to stress something to you as they go over a topic. It's called accumulated other comprehensive income, and I don't want you to get confused by this. And what this is there's miscellaneous items that ordinarily may belong on a balance sheet, like maybe under income from operations or underneath net income. They actually have an effect on equity because ultimately, remember, net income has an effect on equity, doesn't it? So, but these are items that larger companies may have that are related to the income statement. But what they've done is they've decided to put them as line items on the changes in stockholders' equity statement. Okay. So first, they will always pull the net income over. And we, of course, learned that from chapter 2. It's not a problem, right? To understand that net income ultimately becomes an increase in equity and a net loss, a decrease in equity, right? So we're pulling that over. But we're also acknowledging, I'm going to look at my list here, cumulative foreign currency transaction adjustments. So if you issue a balance sheet on a certain day and the foreign exchange has adjustment may need to be made related to a change in the exchange rate for foreign investment, right? So we not remember these are usually unrealized gains or losses, but we feel like that they need to be put on the balance sheet so that investors are aware of these potential changes, right? These potential gains and losses. Those gains and losses can be for an investment that you have put up for sale officially. So they are available for sale. And what they want to do is they want to take maybe a segment of their business and set it out for sale, but they don't want it to affect the income from operations calculations and the net income calculations related to earnings per share. And that's what really this is all about, guys. It's not mucking up, making gray into an area that's kind of black and white. This is your earnings per share from income from operations. This is your earnings per share from net income. And so there's a lot of things that are out there that potentially could affect those equities, right? That are related somewhat to the income statement. But we want to put them on the balance sheet directly because they are, remember, this is non participatory, or as they put it in the book, non shareholder changes. So these are changes in equity that don't really have to do with the shareholders, right? The ones who own the stock. So they want to put it in a separate category, and they have done that since like 1987, and I think was proposed, and then shortly thereafter, it was enacted that we would have this section. So remember the statement of changes in owner's equity in Chapter 2. It was strictly either paid in capital or it was retained earnings. But really, there's a third category, and that's the accumulated other comprehensive income section. And sometimes it's labeled as that, and then the items are listed underneath it. And sometimes those items are just listed, right? And so they're items related to changes in any kind of provision that you have for pensions, right? Or changes that you have in post retirement pension provisions, or possibly some kind of gain or loss as it relates to a derivative that you have purchased to protect the company, right? For in those foreign transactions. So if you have a potential gain or loss from that, and keep in mind that these are often unrealized gains or losses, but they are items that we feel like as accountants should be included somewhere on the financial statements, and they've chosen to put these on the state changes in stockholders' equity. Now we're going to continue our discussion with the journal entries related to equities and how the participatory or shareholders typically are affected. So let's take a close look at these and understand what we're looking at when we start to record these journal entries. All right, now I'm going to scroll down here to the journal entries, and you'll see here in A, okay, that we have sold some preferred stock. We could say that we issued this preferred stock, and it has a par value of $100. There's 7,000 shares, so we're going to get $700,000. So we're receiving that cash, and we're issuing that preferred stock. So we're issuing it, remember, at par value. Okay. Now in B, we're issuing preferred stock, but we're doing it for land. Now, a lot of times common stockholders get a little bit upset if a company is at a point where they have to issue preferred stock. And when I say upset, it just kind of dilutes the potential dividends that they may can get at a later date, because the preferred stockholders so often get that cumulative amount that they are going to get regardless of whenever they pay the dividends, right? And so that comes out of shareholders. So a lot of preferred stock is not floated in stronger companies. And so what happens, though, sometimes is that there comes an opportunity where we can issue preferred stock as a company and swap it for land. So we're getting an asset that the company can use to grow, land, if you will. And when we do that, though, we're going to issue the preferred stock at its par value. Okay, we're going to give them 4,200 shares for this land, and then we're going to record the fair value of the land. Now remember, whenever there's a stock transaction, it's the fair value. If you're having a cash transaction for land, you would record land at its cost. But if you're buying land with preferred stock, then you would record it at its fair value. So that's an important point and a tested point in the author's test bank. And any kind of additional paid in capital you may have over that par value amount, then you would flow it into this account that's called additional paid in capital, which kind of gets anything with it's an overflow over the amount that you record the stock. Okay, so let's look at C. We have an issuance of common stock, right? And we're going to record that common stock at its $5 par value, but we're getting a whole lot more for these 48,000 shares, right? We're getting $16. So we can take the 16 times the 48, and we can say, okay, we're going to get that much in cash. We're going to debit cash. And then we're going to record common stock at its par value of $5 per share. And then all the excess is going to go into that same additional paid in capital account. Because our stock carries a par value, then we use an additional paid in capital account a good bit. Now look at D real quick. I want to just really zero on home. Make sure you understand this. The company decides to buy back some of those shares that are off in the market. Now understand that these shares have been authorized by the SEC, basically turned into a financial instrument, and they've been sold on the open market. But you as a company decide to buy back treasury stock off the market, right? And they call it treasury because it goes into the treasury is what they call that. And when it does, it goes into an account and it is debited. You notice we're paying cash for this stock, right? So we got to credit cash. Well, what are we going to debit? We're going to debit treasury stock. Well, what kind of an account is treasury stock? Well, treasury stock is a contra equity account. So beware of that, right? So that means it's going to be opposite of than how equity is usually recorded. Equity is recorded, remember, as a credit. but treasury stock would be recorded as a debit. Okay. And also you have to sort of think, well, what is that going to do then to my total stockholders' equity? Well, I'm paying cash for this, right? Asset for this. And that means I'm kind of decreasing my equities, aren't I? If I decrease assets and liabilities stay the same, then equity has to decrease, guys. That's the accounting equation. It works, right? So just remember that treasury stock decreases your stockholders' equity. If you look over here in E, we turn around and we sell that treasury stock. Now take particular notice that when we sell that 9,000 shares of, and we're not selling all of it that we bought back, we're selling some of it. That treasury stock though that we bought for $18 per share, remember, is on the books for what we purchased it for. Look back here at D. When we recorded that treasury stock, we recorded it for what we paid for it, not its par value, but what we paid for it. And then when we sell it, we have to credit it for what we paid for it. Okay. Now we're getting $21 per share for these 9,000 shares, so that's the 189,000. And then of course we have the treasury stock here, and so that treasury stock is based on what we paid for the stock. And then of course anything more that you get for it, then it goes into additional paid-in capital once again. So take special attention to that, because that is a test question. Okay. Now in F, we do something real simple, guys. We issue a cash dividend to our stockholders. Typically, this is done at a certain date. In other words, the board of directors gets together and they issue a cash dividend. And when that happens, we make a journal entry. We take it out of retained earnings and kind of put it in a payable amount, because we are creating an obligation. If we say that the stockholders on a particular date are going to get $1.75 per share, then we are going to record that as a payable. Right? We were creating an obligation. The board of directors is doing that, and it automatically decreases our retained earnings. So take a close attention to that. The common stock that's outstanding, 7,000 and 4,200, are added together and then multiplied by how much per share that cash dividend is. Okay. Now, if you'll see here in G, we are issuing good important stuff, guys. We're issuing a stock dividend. Okay. Well, what did we issue? We issued 8%, right, on 48,000 shares. Okay. Now these are the amount per issue, right, that have been issued. So we multiply 8% times that 48,000 shares and we get 3840. Now that 3840 then, right, is the times the par value is going to be credited for common stock. And then any excess for that is going to go into additional paid-in capital. So this up here is $25 per share, the 96,000. This is $5 per share, right, in common stock. And this is the $20 per share in additional paid-in capital. And that way the debits equal the credits. Okay. Now take special attention to this, guys. And note something here. In this particular transaction, you are decreasing retained earnings and you're increasing paid-in capital. So if you increase one and decrease the other, what overall effect does that have on stockholders' equity? The answer is none, right? Because you're basically decreasing and increasing two sections, if you will, on the statement of changes in owner's equity. And so it has no effect, okay, on your total stockholders' equity whenever you issue a stock dividend. Pay attention to that. Also, guys, I want you to go into your chapter and I want you to pay attention to stock splits. And I had mentioned this before, but I'll mention it again. Make sure you know about stock splits and how those stock splits are recorded. Okay. And just take a look at that in the chapter and make sure you know that, because that's going to be tested as well. Okay. So this gives you a really good dose, guys, of tail end of chapter 8 here. Kind of recap some things for you. You'll need, this chapter is not long, but it can get a little bit confusing here and there. But I hope I've cleared some of that up for y'all.